Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Lululemon are falling after the company announced former Nike executive Heidi O'Neill will take over as CEO. You can see down at 11.5% right now. O'Neill spent more than 20 years at Nike and is set to step into the role in September. She takes over at a tough time. There are weak sales, rising competition, and a recent sizing controversy. Lululemon shares are down more than 35% over the past year. Shares of Lockheed Martin are off by close to 4% after the company missed profit estimates in the first quarter. The drop was driven by weak production performance, including delays in the F-16 fighter jet program and delivery delays on the C-130 transport aircraft. Despite those issues, the company reaffirmed its full year 2026 outlook, pointing to new U.S. government contracts as a potential source of growth. And shares of Tesla are off by 3.3%, despite the company posting a profit beat. The muted reaction comes as Tesla says capital spending will top $25 billion U.S. this year, well above expectations. The company is ramping up investment in AI, humanoid robotics, and the cyber cab platform. Elon Musk says the heavier spending is meant to set the stage for much larger vehicle production down the road. Well, stocks are retreating from the record highs reached by the S&P 500 and NASDAQ composite in the previous session. They're kind of bouncing back, too, a little bit. They're right hovering last time I looked. Of course, optimism fading over maybe a quick end to the Middle East conflict. So where are the buying opportunities amid the geopolitical uncertainty? Let's bring Eddie Gabor, CEO of Key Advisors Wealth Management. Eddie, thanks as always for joining us.
Thank you for having me.
So where are some of the opportunities right now? It is a bit of a madhouse, isn't it?
It sure is. I mean, we are witnessing a historic snapback. This is the fastest snapback in history when you take a look at where we were just 2.5 weeks ago to where we are now. And I think the dilemma that a lot of investors have is they continue to doubt this rally due to the fundamentals. And this is a time period where you have to, as crazy as this may sound, ignore fundamentals and respect what the technicals and momentum are telling us. And this is a momentum move, and you have to stick with the leaders, in our opinion. And when you look at the leadership right now, I mean, semiconductors really stand out, and we're getting ready to head into earnings season. Earnings look like they're going to continue to be strong. So this market right now is telling us, we'll find out if it's right or not, that over the next 30 to 60 days, the issues we're dealing with in the Middle East are going to be much less of a concern. Oil has probably topped, the dollar has probably topped, and the VIX has probably topped, which is setting ourselves for a continued risk-on rally in the areas of strength, hopefully going into the summer. Now, we know if oil stays really, really high and elevated for a long period of time, there'll be some negative ramifications from that. But we are, at this point in time, that's probably not going to be something the market's going to need to deal with until a few months out from now. So you got to ride your winners right now. All
right. With you, let's talk about that for a second. What would be high to you? Depending, what would be high to you?
In regards to oil prices?
Yeah.
I think if they stay over 90, that's a problem. You know, I think oil needs to trend down and be under 90 and start trending towards that $70 range. Because, again, if it stays at where it is now, even though it's below the 117 to 118 peak, it's absolutely going to be problematic for consumers and businesses due to diesel costs and all the other things that are associated with that. So where we are now, to me, is too high. The market's telling us it's going to be lower in the coming weeks. So we'll have to wait and see. But respecting the technicals and the momentum is something that some investors are learning the hard way.
And you mentioned some optimism. What are some of the other reasons for optimism on this market? What gives you that confidence?
And momentum in regards to earnings. You know, coming into the year prior to the attacks on Iran, you know, the economic growth was looking pretty strong domestically, where it was going to surprise to the upside. You have a Fed that's going to be cutting rates, whether it's 1 or 2 times this year. That's still in play. And earnings are strong. The biggest thing that's thrown a curveball in this is the strikes in the Middle East that have caused oil to go vertical and become a real problem for inflation. So the fundamentals of earnings, economic growth, and a more dovish Fed over the next several months are still in play. And that's what the market right now is betting on, which is why you're seeing this historic move.
All right. And you've got some emerging market ETF picks. Let's get into those. First up, iShares MSCI Emerging Markets ETF.
Yeah, so right now, if we're going to see a de-escalation overseas in the coming weeks and oil's going to trend down, the emerging markets, we think, will outperform domestic markets because they've been hit really hard, harder than the U.S. markets due to these geopolitical issues that are going. So it's a bet on the fact that we'll see a de-escalation in the coming weeks. So we really like emerging markets here.
And what, and certain areas or just in general?
So there's 2 ETFs on how we're playing it. EEM is one where it's more of a broad-based, and then EWY is another ETF. And this is really a bet on Samsung from an international technology play. This company has had some fantastic earnings. This ETF has continued to perform really well. It's very aggressive, so it's not for the faint of heart. We have it in place for our more aggressive clients, but that's how we're playing the emerging markets, more broad-based on the EEM side and more concentrated on the tech bet of Samsung with EWY, because that's such a big component of that ETF.
Yeah, and Korea is an interesting place to say the least, isn't it?
Absolutely. The volatility is insane, which is why we say it's not for the faint of heart. But it has some really nice upside potential, as we've already seen so far year to date with all the volatility we've been dealing with.
Okay, another one is the iShares Expanded Tech Software Sector ETF.
Yeah, so IGV, that is a bet, a contrarian play. Software has really gotten beaten up. We started getting out of software last August, and now we're starting to buy the dip there. And IGV today is taking a hit due to some of the earnings that have come out, but we think they're going to start bottoming process here. Microsoft reports next week. If it sells off due to that, then we would put on another position there as well, too. So we have a minimum position there. We plan to buy dips in IGV, and that is a true contrarian play on this market reaccelerating once we get through earnings season.
And what's made you change your tune on that, on software?
So what's changed our tune is just how negative everyone is in software. And the fact that, a lot of these names lost 30, 40, 50%. The IGV was down 30%. So that risk reward, because of where we sold at such a high level for us and being able to take capital and buy something that's down 20+%, for us was a fantastic risk reward. We're not as bullish on that as we are on the semiconductors, but we think the IGV is going to be a catch-up trade. So it's really a contrarian play based on all the negative sentiment. When everyone's on one side of a trade, a lot of times it's prudent to take the other side. And I think that's what you're seeing in software, which is why it's had a pretty strong bounce here from the March lows.
All right, let's talk about semiconductors. iShares semiconductor stocks.
Yeah, so again, semis are our favorite place. When you see market strength in this area, it just kind of speaks to the strength of the market, because semis usually lead to the upside, and they also lead to the downside. And so SOX ETF as well as SMH is another ETF. And this is, again, just broad-based, getting exposure to all the semis. You look at companies like, Marvell, which is on fire. Even CoreWeave is catching a bid. You're looking at names like NVIDIA that are post-earnings, we think will make new highs. So it is a leadership place that we want to have some strong exposure to, because these are the outliers that we are buying to try to outperform the broader market. And we think semis will continue to lead the way there.
All right, and last one, iShares Russell 2000. The Russell 2000 has had a quietly good recovery, hasn't it?
It sure has. This is our strongest conviction area, is small caps. Because, again, that was our strongest conviction coming into January until we had the war overseas. We saw what high inflation can do to small caps. But if we're getting ready to head into an era over the next few months of a dovish Fed and earnings that are going to accelerate, the bar is set really low for small caps. And their earnings beats have going to be pretty impressive, in our opinion. And if the U.S. economy accelerates on the growth side, we think small caps are going to continue to outperform by a wide margin. And all these plays are higher risk plays. So again, you have to have the right risk tolerance. But for us, we think they have been great calculated risk reward bets for our clients to complement the other holdings that they have in their portfolios.
Okay, we'll wrap it up there, Eddie, but thanks as always for joining us.
Thanks for having me.
Eddie Gabor, CEO of Key Advisors Wealth Management. And coming up, today's market drivers with Bloomberg's Monique Molina. Time to take a look at today's market movers, and we're joined now by Bloomberg Equities reporter Monique Molina. And Monique, thanks as always for joining us. Let's get right into it. Dow Chemicals, what's unfolding there?
Yes, so Dow Chemicals, they reported earnings this morning, and while they did beat on earnings per share, their shares are trading lower this morning. As analysts say, a lot of that beat was driven by the company suspending the equity losses for the Sadara plant. So while they did see the earnings increase compared to what people had been expecting, some of their segments actually saw lower volumes and lower earnings this quarter, like infrastructure and intermediates. So there are some underlying weaknesses in some of those areas. And they also note that the equity losses suspension is expected to continue into the second quarter. So we may continue to see some of these impacts. The company's also been benefiting from higher margins due to the increased demand for chemicals because of the war in the Middle East constraining supply. But analysts note that if the war does come to an end or if the Strait of Hormuz fully opens back up, then we might see some of those prices come back down, which could impact Dow.
All right, and Freeport McMoran taking a hit today on the Grasberg mine forecast?
Yes. So Freeport also reported earnings this morning, and in their earnings, they forecast that the Grasberg mine was going to take longer to get back up to higher capacity than previously expected, and they cut their forecast through mid-2027 on this. And we're really seeing the shares dropping today on that. Analysts were disappointed to see this. They had thought that the Grasberg mine was finally ramping back up and was expected to reach more normal operations much quicker. And they also note that because this is such a big mine for Freeport, this is going to also mean a lower gold and copper production through 2027 for the company, which is going to weigh on their revenue as well.
Okay, and last but not least, NextEra Energy having a nice response on its renewables.
Yes, so NextEra Energy, they are a utility company in the U.S., and they saw their earnings beat for the first quarter, and they're seeing their shares react positively to this. They saw a high level of originations for their renewables and their energy storage, and analysts are really positive on the outlook for this segment for the company going forward. They also note that there's a lot of energy demand continuing to increase for data center power, and NextEra Energy is already in that space, but is expected to add even more power loads for data centers. So they really see kind of positive trends for the company going forward that they've already been able to capitalize on by adding more loads.
All right, we'll wrap it up there, Monique, but thanks as always for joining us.
Thanks.
Bloomberg's Monique Molina. Up next, nuclear energy is a growing topic as Alberta report shows majority support for nuclear energy, but also safety concerns. That's after the break. Well, our next guest says that many countries and companies around the world are focusing on maintaining and expanding their nuclear fleets. We have more on this with Jonathan Hinds, president of UXC. Jonathan, thanks very much for joining us.
Great to be here. Thanks.
Just how much is there interest in nuclear? I mean, we've heard a lot of talk about it when it comes to the data centers, but is it going beyond that now?
Oh yeah, and AI data has sort of came in late. This has been going on already several years. The energy transition, which now is maybe not as big of a deal for some countries like where I am in the U.S., but Climate change has already been a big factor pushing nuclear forward in a lot of countries. China, for example, a big factor in their net zero targets is nuclear. And then, of course, energy security since Russia's invasion of Ukraine and, now with the Iran situation, we're just seeing so much more interest by countries to diversify away from fossil fuels, to find, more stable sources of power. And of course, the situation with renewables has also been somewhat of a factor supporting nuclear, because people are realizing that you can't go too high on renewables given their intermittency. So nuclear is this great baseload power source that also is non-emitting. It's North America, it's U.S., Canada for sure, but also Europe. We're seeing huge gains there and a lot of growth potential. China is still the world growth market for nuclear. About half of all nuclear plants in the world are in China. Russia is a very successful exporter of nuclear power. They've got reactor projects in almost 10 countries. India is looking good, but Japan, Korea as well. So it's quite a broad kind of global picture for growth in this market.
And is this what we're seeing in the Gulf and with Russia? Are those going to be the catalysts that will speed this up, do you think, possibly?
I think so. I mean, the first big nuclear boom we saw was in the 70s after the oil crises at that point, when countries realized that reliance on Middle East oil and these days also gas was not something they wanted to do. So France is a perfect example of a country that went from heavy fossil reliance to almost 70% nuclear in their electricity mix. And I think countries are looking again to nuclear to be the answer to, but be that buffer against potential fossil uncertainty. I mean, natural gas has been the #1 go-to fuel for electricity across the globe over the last, I'd say, almost 2 decades. But now even gas is looking, not everywhere, but because of the situation in the Gulf, countries, especially Japan, Korea, and some other markets are certainly, even Taiwan is now shifting back to looking at restarting some reactors that they shut down. And I think some of that is because of the unpredictability on natural gas. So yes, it is a big factor, and I think it'll have a long-term impact.
Now, I mean, even like in Alberta, there's actually interest. We were just talking about that poll before we came in here. But there's also concerns. What has changed with nuclear from the 70s to now? I mean, we had 3 Mile Island, Chernobyl, and Fukushima, I guess, but I mean, that was more earthquake related. But what has changed that might ease people's fears about nuclear?
Yeah, I mean, look, it's obviously a complicated technology that has to be managed well and regulated well. But we have had a few incidents you mentioned that have been severe, and of course, those are the ones that everyone looks to. But the fact is that we've had hundreds and hundreds of reactors operate for decades with no major incidents. So typically when they do the public polling around nuclear plants, the support for nuclear at near the sites is much higher than the general public. And that's because once people are familiar and comfortable with this technology, they realize that it is generally very safe. Now, new technologies have come in, even the existing kind of light water, heavy water fleet that we have today. There have been a lot of advances on technologies to make them safer, to reduce the potential for major accidents. But then we also have these advanced reactors now that are, in some cases, you don't want to argue they're safer, but they might have new advantages on the safety side that other technologies that we've used before don't. So, we've got high temperature reactors, molten salt reactors, and micro reactors that are sort of encased in very small, and can be much less, have less radioactivity generally. So all of those are advances. I think the new technologies of the future are going to include those traditional designs, just with the big, more safety features, and also these advanced micro and small reactors, SMRs, some call them, that are, in some cases do have even more enhancements on the safety side. But look, nuclear, it's a big part of the electricity market already, and I think people are realizing that it has a place. No one's expecting it to go like France to 70% in every country, but certainly the growth and the safety part of that is key to making sure that we have the growth.
And what countries are leading the technology? Not necessarily building reactors, but leading the technology on that. Canada had CANDU for a long time. Are they still at the forefront when it comes to advances?
Look, I mean, in North America now, the U.S. and Canada, this is one area where our countries are still collaborating and actually good friends. There's a great example of that in Darlington in Ontario at the Ontario Power Generation site, where a U.S. company, actually U.S.-Japanese, GE Vernova Hitachi, is building a first-of-a-kind small reactor, 300-megawatt reactor at the Darlington site. And the Canadian, Ontario is the lead on that. And so that's an advance that's sort of across borders. In terms of technology development, I'd say U.S. is still seeing a lot more of that than maybe Canada internally, but Canada is providing. You mentioned Alberta. We're also seeing Saskatchewan, New Brunswick, obviously many parts of Ontario, all looking to nuclear. So I think, having that demand signal from Canada is really important for some of these U.S. companies. But other places, we see some Rolls-Royce out of the U.K. is one more that's coming in pretty strong. There's some technologies coming out of China and Russia as well that are more on the advanced side. But even Korea and Japan have some role in that. But nuclear is a niche market, so a lot of the companies can't just go it alone in one country. They need to have multiple jurisdictions where they operate to make this work.
All right, we've got to wrap it up there, Jonathan. But thanks very much for joining us.
Yeah, great. Thank you.
Jonathan Hinz, president of UXC. Coming up, shares of Rogers Communications are up sharply after the company met estimates and raised its cash outlook. That's next. Warner Brothers Discovery shareholders have voted overwhelmingly to approve a merger with Paramount Skydance, despite widespread opposition to the deal in Hollywood. Paramount will buy Warner Brothers for $110 billion, beating out Netflix after a months-long bidding war. The deal is still facing antitrust review in several jurisdictions, including the U.S. and EU. If regulators end up blocking the deal, Paramount will have to pay a $7 billion termination fee. The U.S. Justice Department has reclassified state-regulated marijuana as a less dangerous drug. The directive moves licensed marijuana products from Schedule 1 to the less strict Schedule 3. The move stops short of fully legalizing the drug for recreational use nationwide, but it meets the demands of many advocates who have long argued for looser restrictions. Shares of Tech Resources are up after the company posted first quarter profit that more than doubled from a year ago. The miner also reported revenue that beat expectations, coming in at nearly $4 billion. The company says the strong quarter was driven by higher copper sales and solid operations. The results come as the company continues to work on its previously announced deal with Anglo American. Shareholders have approved the transaction, but regulatory okays are still needed. And a quick look at the markets, and the TSX has managed to claw its way back up into the green, albeit ever so slightly. All the uncertainty in the uncertainness in the Middle East playing on a lot of people after a good run over the last few weeks. Leading the way, industrials up by more than 2.4%. South of the border, similar situation. It's almost flat right now. S&P 500 ever so slightly in the green. Dow Jones down slightly, hardly worth mentioning. NASDAQ the same. They've kind of bounced back a little bit as everyone awaits what's next in the Middle East. Well, shares of Rogers are taking a breather after surging yesterday on the news. The company boosted its cash outlook as it cut capital expenditures and posted earnings that met estimates. Let's get more now from Jerome Dubray, research analyst focused on telecom and media at Desjardins Securities. Jerome, how are you, sir?
Well, thanks for having me, Roger.
Rogers, I guess the big thing that everybody's talking about is decision to cut capital expenditures by about 30%.
Yeah, that was the talk of the town yesterday, for sure. A big decision, a massive cut actually that we've seen for 800 million approximately that they're guiding for throughout the year, and most importantly, expected to be sustainable over the next couple of years. Several reasons driving that, but essentially the company is aligning its capital allocation strategy to what we were already seeing in the market. So you can think if a company doesn't have all that many capital redeployment opportunities, it might not be that positive. But that was already reflected in the market, and essentially seeing the company having a better alignment with the current condition was definitely a positive yesterday for us.
And any concerns about where the money was being cut from or what's staying?
No, not really. We have confidence in that management team for network investments. The CapEx has been very high in the last couple of years as they were integrating the Shaw acquisition. So we have confidence in the network that they have, that they are going to be building on. So no concerns on that front. This is also coming closer to some of the peers that we're seeing in the market. So 12% CapEx intensity that the company is guiding for in the next couple of years is actually the same as what we're already seeing from Quebecor, which is busy deploying a network right now. So we think this is an appropriate level of CapEx spending for them going forward.
Do you think that was part of the reason for them was coming more in line with the other telcos?
Yeah, there's a bit of a different strategy for the other companies, definitely more in line with TELUS. However, TELUS is essentially done with its fiber deployment program. They're still deploying fiber, but the bulk of their deployment is already done. So to be understood that TELUS CapEx should be lower than Rogers in any given year. For Bell, it's higher than that. The thing, though, is that we like about Bell here is that they do have attractive CapEx opportunities here, notably on the data center side. We think those are attractive opportunities for Bell. So we don't necessarily want them to be cutting the CapEx where Rogers is, but probably there's a case to be made that on core Canadian telco operation investments could probably be lower.
All right, we're just gonna bounce for a second and stay with BCE, our parent company, and tell us what are you expecting for them when their earnings come out in May?
Yeah, so what we've seen from Rogers yesterday was actually pretty decent net adds on the wireless side. That is leading investors to have a bit of question in terms of market share. Probably Rogers had a pretty good quarter in terms of market share, driving questions for what the other companies will have driven in the quarter. So maybe a little careful on the quarters for Bell and TELUS, especially with the very high competitive intensity we had seen in the first quarter. However, longer term, we do see better opportunities for them.
Okay, and then and go back to Rogers again. With that money, where's it going?
Yeah, so Rogers need to delever. They post the Shaw acquisition, they've had a high leverage, but also there's the MLSE acquisition that they've had from Bell from last year, and now they want to fully consolidate the MLSE operation. So we're expecting a transaction with Kilmer Group, Larry Tannenbaum here to buy the remaining 25% of MLSE. So plenty of spending opportunities for them for sure.
And with the MLSE, how do you see that unfolding, and where does it go from there? Is it being brought together to be sold, or is it just being brought together because they want to own it all?
Yeah, that was another positive from the update yesterday. The company on its call said that it now evaluates the full value of its sports and media assets to be north of 25 billion. The previous conversation that the company has had with the street was more talking about a 20 to 25 billion range. So the issue that we have there is that first, before they can sell more shares of MLSE, they need to be buying more. And historically, the market has shown us that they preferred seeing Rogers owning less. So yes, there's a catalyst that's going to be coming that Rogers wants to be monetizing MLSE at some point, but they need to be buying first.
Or could we see it being set up that they're going to keep the MLSE and sell the rest of the cable and phone and everything? Okay, now I'm just having going off on a tangent on that one. Now they did manage to add more mobile subscribers as well, even with the weakening population numbers. How'd they do that?
Yeah, so numbers were not great. When I said they were decent, it was in the context and versus expectations, right? So right now we are in a very low volume kind of environment. Everyone knows the population growth is very low in Canada these days. Q4 was the first time in a very long time that we had seen a negative year-on-year population growth. So this doesn't help when you're trying to sell cell phone subscriptions for sure. So right now we're probably around the trough in terms of volume growth. This hurts those companies, but we do see a path for a better performance in terms of loading in the coming years.
All right, and almost out of time, but you're keeping them at a hold for Rogers.
Yeah, that's correct. We have Bell at the top of our pecking order. Really like the data center initiative that they have, and it's trading at a bit of a discount depending on how much value you're going to be giving Rogers on the sports assets. So still very good news on the CapEx side yesterday, incremental good news on the leverage side, but still a cable operation that will need investments over time and just see better capital redeployment opportunities at Bell at this time.
Okay, Jerome, we have to wrap it up there, but thanks very much for joining us.
Of course, thanks so much.
It's Jerome Dubras, research analyst focused on telecom and media at Desjardins Securities. And of course, BCE is our parent company. Coming up, marijuana stocks are reversing some of the gains after a major move from the U.S. Justice Department, what the DOJ's classification means for cannabis. Marijuana/cannabis stocks are in focus today after the U.S. Department of Justice said it is reclassifying FDA-approved and state-licensed cannabis as a less dangerous drug. The move shifts marijuana from Schedule 1 to Schedule 3, easing longstanding restrictions but stopping short of full federal legalization. Joining us now to break this all down is Pablo Zwanich, the managing partner at Zwanich and Associates. Pablo, thank you very much for joining us today.
My pleasure. Thank you.
So where do we stand now with the move from Schedule 1 to Schedule 3?
Yeah, this is a big deal. We have to remember marijuana was put in Schedule 1 back in 1970 when the CSA was passed, meaning no medical use, high potential for abuse, essentially illegal. Today, 56 years later, there's a final order issued by the DOJ that classifies medical marijuana as Schedule 3. And that's with immediate effect as of today. That has a number of advantages. The ones that are most talked about is that you can do research on it at the federal level, state level, and advance the cost of marijuana. That's number one. Number two, there's going to be a process for medical operators to register at the federal level with the DEA, which we think will have quite a few benefits from a federal perspective. And number three, because there's something in the US, a tax rule, that forces companies dealing in Schedule 1 and Schedule 2 drugs to pay income tax on gross profits. By moving to Schedule 3, they will be able to pay on profit before tax, essentially deducting SG&A expenses and other operating expenses. That's very significant to cash flows of these companies and also to their credit standing. So it's a boost for the industry overall. But what I'd like to highlight here, because there's a lot of focus, of course, on the numbers, and we follow stocks, right? It's two things. One, you show that stocks are down today about 8%, but over the last week, they are up about 30%, right? So the market is correct. This is significant. It's a big change. And stocks are right to be up on a weekly, on the last week. The second point I would make is that there's going to be a process to reschedule all marijuana, right? Right now, it's medical that's been rescheduled with immediate effect, and then you will have an administrative hearing that will follow a specific process for all marijuana, including recreational marijuana, to be moved to Schedule 3. So from our perspective, it's a big deal and very positive for patients and for the industry.
And so with that reclassification for the recreational as well, would would it essentially put the U.S. the same as Canada, where you could go to a store and buy it, it's legal, you can smoke it on the street? Would that be the same situation?
Right. Not exactly, but just to put some things in mind. First of all, it remains federally illegal in the U.S., marijuana. There's no interstate trade, but 40 states, 40, have already approved medical marijuana at the state level, right? And about 25 for adult use. You can go to a dispensary in New York City, New Jersey, and many other states and buy for what we call recreational use. So in that sense, it's similar to Canada. It's different in the sense that it's not federally legal. It's also different in the sense that in the case of Canada, you can export, right? In the case of the U.S., based on our reading of the DOJ's final order today, it's still federally illegal, and companies would not be allowed to export. But look, if I step back for 1 second, to me, the bigger deal here is stigma, which doesn't get talked about enough, right? In my personal opinion, marijuana is safer than alcohol, safer than tobacco. And at the end of the day, there's this stigma around the plant. And we need regulators at the state level and at the federal level to come to terms with the fact of what the FDA, HHS, and the DOJ are telling them now, that it has medical use and it has low potential for abuse. As such, other legislation should follow. Like, for example, you should let banks that are federally chartered operate with the industry. You should let the exchanges list plant-touching stocks. And eventually, you should federally legalize the plant, right? But I think this is a step-by-step process. But I think today it's a monumental day for the industry. And yes, for those that follow these stocks day to day, there's no custody. Retail investors are in and out of these stocks. So today, they saw the headline, sell the news, right? But from our perspective, the underlying trend here is very positive.
Okay, and from the medical aspect and the tax break, will that money end up going back in for medical research for them, or what? Where does that money go? And how much? What do we know? What percentage a company might save with this change?
Okay, there's a couple of things there. First of all, in terms of the cash flow savings for the companies, they are significant. If we put a 10 times multiple on the cash flow savings from not paying to ADE. That's about 3 times their market cap, right? So literally, stocks could triple if based on our math. In terms of the government at the federal level, sure, right? There will be less inflow for the government because there will be less tax being paid, and we'll see how the OMB decides to tackle that in the future, right? But that's a separate matter. But we've calculated. The industry as a whole, it's about $32 billion in sales right now. Of that, about 70% is adult, which again hasn't been rescheduled yet. And the other 30% is medical, which as of today is rescheduled. But the benefits I think that we should focus on is the research aspect, very significant for patients. It advances the cost. Yes, 280 goes away. And companies that are licensed at the state level are allowed to register with the DEA from a federal perspective, which we think will also bring other benefits that are not being talked about, but not interstate trade. But again, from a stock perspective, which is what I do, what I cover, it's a very volatile sector. But today, to us, the news today are very significant and positive. Okay,
Pablo, thank you very much for joining us today.
My pleasure. Thank you.
That was Pablo Zwanich, managing partner at Zwanich and Associates. Up next, we'll discuss best performing stocks in the S&P 500 and the TSX over the past 25 years. Might surprise you. Canada and the U.S. stock markets have delivered nearly identical long-term returns. Those returns came with some major drawdowns, underscoring why position sizing is critical to surviving volatility. For more on this, we spoke with Brian Madden, CIO at First Avenue Investment Counsel.
This is maybe running a bit contra to popular culture in this era of crypto and meme stock and zero-day expiry options and everybody wanting to make the fast buck. We at First Avenue Investment Counsel don't believe long-term investing is dead.
Yeah.
And as sort of an interesting research project, one thing that we undertook to do was look at the end of last year, so we're a quarter of the way through this century, would have been the best performing 10 stocks in the TSX Composite and the S&P 500 over that time frame. So not surprisingly, there's going to be some familiar names like NVIDIA and Apple and so on.
I guess banks here.
No, interestingly enough, they did not make the...
Over the 25 years?
No, so they didn't creep into the top 10. Brookfield in the financial realm did, but there's some surprising names. I think we may have an exhibit, but...
There you go.
So these are the Canadian names. So Stella Jones. So one of the big takeaways is, number one, these are not all tech stocks. In fact, there are no tech stocks on this list. There's only 2 on the U.S. list. Stella Jones makes rail ties and utility poles, so proving boring is beautiful. TFI is a trucking company. When we showed the U.S. board, there's a trucking company there. We've got a convenience store. We've got a T-shirt maker and a heavy equipment dealer. So, not always is all the sizzle in the tech stocks. So that's takeaway number one. But if we sort of size up these Canadian stocks, on average, that list of 10 has averaged 10,236% return since the turn of the century. Now, if we turn our attention to the U.S. names, the granddaddy of them all, the top of the leaderboard is NVIDIA. So yes, that's a tech stock. So is Apple further down the list. But again, there you've got Monster Beverage, that's energy drinks. Old Dominion is a trucking company.
Tractor Supply, TSC.
Yeah, so this is Rural Farm Supply and Equipment Store. So again, the mantra holds, even in this tech-heavy market, boring can be beautiful. Now, what's interesting in point of contrast here, these U.S. superstar names are on average 500 baggers. So I'm just going to look at my notes. 58,187% is the average return of these 10 stocks since the turn of the century. Now, all the sizzle and all the hoopla and the fireworks is probably focused on that first column. But we think investors should not neglect the second column, so the maximum drawdown. So this is the big, big takeaway. This is why we think long-term investing requires conviction, fortitude, and a long-term view, because as those tables show, all but 2 of these 20 stocks have at least once in this quarter century during which they've been massive compounders been cut in half. And on average, among these 20 names, they've been drawn down 70% from peak to trough at the maximum during this 25 years. So the other really important takeaway, we think, is position sizing and portfolio construction and discipline matters, because although you want to be around for the ride and be able to sort of see these through their ups and downs to get these 10,000 or 50,000% returns, you need to size the positions correctly, because enduring a 70% drawdown in one or more names that have an outsized weight in a portfolio can shake you off of the train and you miss the ride. So you want to be disciplined in trimming and taking profits partially along the way. Are the drawdowns the one connection between them all, or is there something else that shows up on all of them? No, so they're very idiosyncratic. So, I mean, there's a place for thematic investing, but we also think there is very much a place for disciplined and diversified portfolio construction, looking for idiosyncratic, best-of-breed players across all of the 11 economic sectors. And, I think this is a really illustrative example that you don't necessarily have to go all in on tech or all in on gold or all in on energy. And in fact, you shouldn't. And how do they compare to the rest of the market on their returns over the last 25 years? Are there other companies? Did you do other companies that? Well, I mean, they just absolutely completely leave them in the dust. So for contrast, the compounded annual return for the S&P 500 over that period, 8.06%. For the TSX, 8.01%, so nearly identical. 8% compounding for 25 years gets you to sort of a 4 or 5 or 6 bagger. These things are 100 baggers and 500 baggers, so it's no contest. Home runs, grand slams. Totally. Double grands. It's hitting 2 grand slams in an inning. Yeah, and throwing a perfect game at the same time. It's a real stand-up performance from all of them. And are they looking, when you look at those companies, are there any forward pressures that you can see with them, or are those companies that kind of just keep chugging along? I mean, we own quite a number of them, and in fact, in keeping with our long-term investment philosophy, have owned a number of them for a long time. But I can't say we've gone, deep in the weeds on all of them, because we don't own all of them. But of those we own, we think they have enduring competitive advantages, structural profitability, incumbency, and great leadership, and we think they've earned the right to continue to win among those names that we do own, and we own probably 6 or 7 of them across those 2 lists.
All right, that was Brian Madden, CIO at First Avenue Investment Counsel. Let's take a look at how the markets are doing on Bay Street and Wall Street. We'll start first with the TSX Composite right now, and it's kind of flat right now, sitting just below 34,000, off by 0.04%. Looking at the different groups, industrials leading it to a little more than 2.4%, but going the other way. Tech is taking a hit today. Healthcare as well. Tech's off by nearly 5. Healthcare by 2.62. And a couple of stocks we want to bring up here. Let's bring in Waste Connections. Do we have that one up there now? And it is up 7% on its first quarter adjusted earnings that per share that beat the average analyst estimate, the biggest gain since 2022 on this earnings beat. So you can see it's at 229.57. One other one we want to mention is Mullen Group. Let's bring that up as well. They are doing nicely. They supply oilfield services, trucking businesses, things like that. And they are, what are they up right now? 4.6% on their highs. They have an earnings beat hit a 2017 high right now. Quick look at the U.S. markets before we go. And you can see they're all kind of flat except for the NASDAQ. It's off by a quarter point. Market calls coming up next. Today on the show, we have Gordon Reid. He is the president and CEO of Good Read Investment Counsel. We'll be taking your questions on U.S. equities. That's it for Morning Markets. Have a great day.